Welcome to the Department of Consumer Affairs webinar regarding the basics of consumer credit. My name is Adam Burr, and I'm one of the attorneys at the department. So let's go ahead and get started. First, we have the legal disclaimer. This presentation is not meant to serve as a substitute for reading the various laws discussed, seeking legal counsel, or otherwise requesting department guidance and/or interpretations on the laws it administers and enforces. The presentation merely serves as an introduction and an overview. So now we'll go over some general terminology about consumer credit transactions. Credit is the right granted by a creditor to allow the consumer to repay a debt later. A consumer is an individual who uses credit for a personal, family, or household purpose, not to make money or for business or agricultural purposes, even if the individual signs a personal guarantee. Now, a creditor is the person who extends credit. Some examples would be banks, credit unions, finance companies, and buy here, pay here car dealers. Now, if you use your credit card, the creditor is the business that issued you the credit card, not the merchant honoring that credit card. Debtor is the person who owes money to the creditor. Now, there's an important distinction between credit sales and loans. A credit sale is when a business sells an item to a borrower and allows the borrower to pay the business over time. So here we have a dealership that sells a car to the consumer. The consumer will make payments directly to the dealership. Now, you could also go to a dealership and the dealership says that it will help you get financing. You get approved for financing with a bank or credit union while still at the dealership, and you are to make your payments to the bank or credit union. This is called indirect financing. It is treated as a credit sale with the contract being sold to the bank or credit union. Keep in mind that you never receive money, so it's a credit sale. Now, a loan is when one business, we'll call it company A, lends money to a borrower so that borrower can purchase an item from another business. We'll call it company B. So here we have a bank that lends money to the consumer. The consumer then takes that money to the dealership. The dealership sells a car to the consumer. And the consumer will make payments directly to the bank. So here's an easy way to remember the difference. If you go to a business and you leave with cash or the equivalent of cash, then it is a loan. If you go to a business and leave with a good or service that you finance, then it is a credit sale. So the next important terms to know are principal and amount financed. Principal is the amount borrowed in a consumer loan. So say you borrow $1,000 from a lender. This is the principal. The amount financed is the amount borrowed in a consumer credit sale. So say you buy a car for $6,000. You make a $500 down payment, and after that down payment, you still owe $5,500. This is the amount financed. So a loan finance charge consists of all the charges imposed on the debtor by the lender related to the loan. An example of a part of a loan finance charge would be interest. A credit service charge consists of all the charges imposed on a buyer by the seller related to the purchase. An example of a credit service charge would be the extra amount you pay for the privilege of paying over time instead of paying cash all at once. So say you sign up for a one-year gym membership. If you pay in full today, it would be $100. If instead you pay $10 per month for a year, you would pay $120. That extra $20 you pay would be the finance charge. So now we come to the difference between interest rate and APR. While the terms are often used interchangeably, there is a difference. The interest rate is strictly the cost you pay for using credit. It does not include other fees and costs. APR, however, is the total cost you pay each year for credit expressed as a percentage. It includes fees and costs such as a fee for investigating your credit worthiness. By having the APR, You can easily compare two or more creditors and determine which one is offering better credit terms. The APR will typically be higher than the interest rate. However, the APR is considered to be a better picture as a whole to determine the total cost of credit and is a better tool to compare rates among different creditors. Now, it's also important to know the difference between closed-end credit and open-end credit. With closed-end credit, there is a definite end date of the credit obligation. For example, I have 60 months to pay off a car purchase. With open-end credit, there is not a definite end date of the credit obligation. An example would be a credit card. The lender agrees to lend me money at a specific limit on a continuous basis. As long as I make minimum payments and don't go over the limit, the lender agrees to keep extending credit to me. This arrangement continues until we terminate our lender-debtor relationship. You should also know the difference between secured and unsecured credit transactions. With a secured credit transaction, the borrower puts up property as collateral. The property used as collateral may be either real estate or non-real estate, such as a motor vehicle. If the borrower fails to repay the debt, the lender may seize the collateral. So here we have the debtor, the creditor, and the collateral, or in other words, the car. The debtor does not pay the creditor. Assuming that the creditor follows all the rules, the creditor will now repossess the car. The creditor has to follow all the rules before repossessing your car. If you get a notice in the mail saying that you did not pay, don't ignore it, because the next step could be the creditor repossessing your car. And by the way, the creditor only has to send you a notice one time, so it is important that you don't miss another payment. Creditors may offer lower rates and better terms on secured credit transactions. And most motor vehicle dealers use secured credit transactions when conducting motor vehicle sales. Now, with an unsecured credit transaction, the lender does not require any form of collateral, but rather takes the borrower's word that he or she will repay the debt. These are sometimes referred to as signature loans or used for services that will not be seized, such as funeral work or dental work. If the borrower fails to pay, the lender will initiate collection attempts. So here we have the debtor and the creditor. The debtor does not pay the creditor, so the creditor starts calling to collect on the debt. The creditor may even report the consumer's failure to pay the debt to the credit bureaus, and the consumer's credit score drops. Lastly, the creditor might sue the borrower to collect the debt and get a judgment. So here's the difference between variable and fixed rates. With a variable rate, the rates change with the market. The rate on any outstanding balance changes as the U.S. prime rate increases or decreases. The prime rate, also known simply as prime, is the interest rate that commercial banks charge their most creditworthy customers, generally large corporations. Rates for mortgages, small business loans, and personal loans are based on prime. The most used prime rate is published by the Wall Street Journal each day. So here's an example of how a variable rate works. Say the APR on a credit card is prime plus 12.75%. In this instance, the margin, 12.75%, is added to whatever the prime rate is at the time to come up with the total rate. Let's say that the prime rate is 5%. The total APR would then be 17.75%. Now with a fixed rate, the rate remains the same through the duration of the term. The borrower will pay the same percentage of the finance charge throughout the duration of the term, regardless of any changes in the market rate. So now that you understand the basic terms, we'll go over what you need to know before applying for new lines of credit. First, there's what you should know about advertising. Sellers and lenders may not advertise regarding rates, terms, or conditions of credit that are false, misleading, or deceptive. Advertising that complies with the Truth in Lending Act does not violate the prohibition on false, misleading, or deceptive advertising regarding the rates, terms, or conditions of credit. Motor vehicle dealers also have some additional requirements regarding advertising. So here's an excerpt from our consumer auto buying guide found on our website. Some of our tips include reading the fine print so you will know if any exclusions apply, whether you qualify for any rebates or discounts, seeing if the advertised price is based on you getting financing, see if the closing fee is disclosed and included in the advertised price, see if the disclosed financing terms will work for you, see if the vehicle is marked new or used with the year, make, and model included. Also, be leery of advertisements using the word free, and also note that it is illegal for an advertisement to guarantee the value or range of value for your trade-in. Here's an excerpt from our dealer's guide, which is also found on our website. By reviewing the dealer's guide, you can be aware of what dealers must do in order for their advertisements to be considered legally compliant. Here are some licensing and registration requirements, specifically what is available on the department's website to assist you in doing your research before you apply for new lines of credit. You can look on our website for a listing of all the industries that we regulate. Specifically, as it relates to consumer credit, the maximum rate schedule and closing fee notification will likely be the two most helpful filings in your research. First, there is the maximum rate schedule. Any creditor charging over 18% APR must file a maximum rate schedule with the department. What the creditor files with the department is the maximum possible rate that the creditor can charge. Now, you could be charged less than this amount. This is just the maximum possible rate that you could be charged. Next is the closing fee notification. Any auto dealer that wants to charge a closing fee must file a closing fee notification with the department. The dealer has to file the notification and the department has to say it is reasonable. What gets permitted is the maximum amount of a closing fee that the auto dealer may charge. The dealer is not required to charge a closing fee at all and may charge you less. The closing fee that gets permitted is just the maximum amount that a dealer could charge. Here's where you can find the maximum rate schedules and closing fee notifications. We even have the maximum rate schedules broken up by industry type to make it easy for you to compare the maximum rates of various creditors. So now let's look at some required disclosures before signing a credit contract. Specifically, we want to talk about the Truth in Lending Act, commonly known as TILA. This is a federal law that requires certain information about credit transactions to be disclosed to you. Regulation Z lays out the rules for making these disclosures. The information required to be disclosed is often in the format of easy-to-read boxes. So here's an example of the required disclosures under TILA. This is a sample contract for a gym membership. Here you can see the information that is required to be disclosed to you. This includes the APR, the finance charge, amount financed, total amount of payments, the total sales price, the payment schedule, and any late fees. All right, notice to co-signers. If a person other than the spouse of the consumer agrees to co-sign a loan, that person must be given notice that he or she may have to pay back the debt if the consumer fails to pay it. The notice must be in writing, signed by the co-signer, and must be clear and conspicuous. If the required notice is not given and signed, the co-signer is not obligated to repay the debt. If your principal dwelling is used as collateral, you must be given a right of rescission. You have 3 business days to cancel the transaction. If the creditor fails to notify you of your right to cancel, then you have 3 years to cancel. Here are some of your rights after the contract is signed. In most credit contracts, there is not an automatic right to cancel. However, certain credit contracts give a right to cancel by statute. If the statute is silent, then you have to look to the terms of the contract for cancellation rights. If the contract does not grant you a right to cancel, then there is not a right to cancel. Now, a creditor is required to give you a written receipt for each payment. A periodic statement showing the payment is sufficient. So an example would be your monthly statements. Upon written request, a creditor must provide you with a written statement of the dates and amounts paid within the last 12 months. The statement must be provided to you at no cost once per year. And after you have paid off the debt, the creditor must provide you with written evidence acknowledging payment in full. Now, it is common for your debts to be sold. This is known as assignment. You have the right to pay the original creditor until you receive notice that rights to payment have been assigned and payments must be made to the assignee. A notification that does not reasonably identify the rights assigned is ineffective. You may request proof that an assignment has been made, and the assignee must seasonably furnish reasonable proof that assignment has been made. If the assignee does not provide the proof, you may continue to pay the original creditor. An example would be your mortgage loan being sold to another servicer. A colleague told me that she bought a house. Before she made the first mortgage payment, she received a letter informing her that her mortgage was sold. A few months later, she received another letter informing her that her mortgage was sold again. Here, this is an example of two assignments made in a relatively short time. Now we come to a notice of a change in terms of a revolving account. A revolving account is an open-end account like a credit card. If your lender is going to increase certain charges, such as finance charges or minimum charges on your revolving account, the lender must have your written consent or send you a written notice 30 days before the change in terms is effective. The notice must disclose that you may terminate the account or you may apply for a new account on new terms. An example of when a change in terms notification is required is if the finance charge increases from 12% to 17.5%. Now, for consumer loans and credit sales, you can prepay the entire amount owed at any time without penalty. When I bought my car, I frequently paid extra on the payments to reduce the outstanding principal balance. During the pandemic, I received my tax refund and the first round of the stimulus money around the same time. I didn't want to pay any more finance charges than I had to, so I used that money to pay off my outstanding balance. For a first or junior lien on real estate, you can prepay without penalty if the total of all sums advanced does not exceed $630,000. Whenever I get my tax refund this year, I will likely use a portion of it to pay extra principal on my mortgage. All right, so now we come to some true-false questions about credit. Bailey Parker, our communications director, is also on this webinar, and she's going to launch some polls. It's going to be true-false questions for you to answer. So Bailey, can you go ahead and launch the first poll?
Yep. Okay, so first one is APRs are capped in South Carolina. Is this true or false? Okay, I'm going to close this out and I will share the results. So this is a straight 50-50 here, Adam.
Wow. All right. So the answer is actually false. APRs are not capped in South Carolina. Rates are deregulated in South Carolina, meaning that the market controls. Creditors can generally charge any rate they want if they do two things. They must file a maximum rate schedule with the department, and they must post that maximum rate schedule in a conspicuous place in their business. Now, I said generally because there are some additional restrictions on loans that are $600 or less, but these additional restrictions do not apply to credit sales. All right, Bailey, can you go ahead and launch the next poll?
Yep. Okay, this one is I have an automatic 3-day right to cancel my contract. True or false? Okay, I'm going to close it out again. This is really funny to me, actually. So again, it's 50-50 split here.
All right, 50-50. The answer is false. There is not an automatic 3-day right to cancel. Sometimes there is a right to cancel granted by statute in a few limited circumstances. For example, the Physical Fitness Services Act gives you a 3-day right to cancel a gym membership. This is a specific right granted by the statute. As mentioned earlier in this presentation, if the statute is silent, then if you have a right to cancel, it must be spelled out in the contract. If the contract is silent, then you do not have a right to cancel. All right, Bailey, can you launch the next poll?
Okay, this next one is I can get new lines of credit with a bad credit history or no credit history. True or false? 80 to 20%, 80% true, 20% false.
All right, so this one is actually true. You can get new lines of credit even with a bad credit history or no credit history. Creditors might still be willing to offer you credit. The APRs will likely be higher. Some lenders might be willing to give you a secured credit card or a credit card with a lower limit. Now you can use this as an opportunity to either build or rebuild a favorable credit history so that you could possibly obtain credit with better terms in the future. All right, Bailey, can you launch the next poll?
Okay, I can get credit without collateral. Everyone said true.
All right, this one is actually true. You can get credit without collateral. Unsecured lines of credit are available, and they just might have higher APRs than secured lines of credit. All right, Bailey, can you launch the next poll?
Contracts must have a wet signature, meaning I physically sign with a pen in order to be binding. True or false? 40% said true, 60% said false.
All right, the answer is false. Contracts do not need a wet signature to be binding. The law allows for contracts to be signed using electronic signatures. And these electronic signatures are just as valid as wet signatures. And Bailey, can you launch the last poll?
If a term violates the law, the entire contract is void. True or false? 73% said true and 27% said false.
All right. So the answer is actually false. A contract with illegal terms does not mean that the entire contract is automatically voided. Many times the contract can be reformed to comply with the law. And depending on what the creditor did that was illegal, you may be able to sue the creditor to recover refunds of excess charges you paid or even some civil penalties. Right, are there any questions? Again, you can use the questions feature to type them in. All right, I think I see one. Oh, I see another one.
Adam, there's two of them here. The first one is about car repossession. So she asks, if a car is repossessed, what are the laws to paying the deficiency amount?
All right, that is an excellent question. So after the car is repossessed, you might still have an outstanding balance on it, depending on if what you owe is worth more than what the car is. So you would want to speak to your lender to see if anything else is owed, to make sure that the lender doesn't sue you for any type of deficiency judgment. Most of the time, though, if you default, the lenders will repossess the car, and a lot of the times it's like the debt's done. It might be negatively reported on your credit reports, but just double check with your lender to make sure that you don't have anything outstanding that you would still need. The lender doesn't sue you for a deficiency balance. That is an excellent question. All right.
The next question is, are verbal contracts legally binding?
All right, so verbal contracts can be legally binding in some instances. So our law actually allows for you to contract for an APR of up to 6% with a verbal contract. So in some cases, they can be legally binding, but it kind of depends. But if they want to get a finance charge over 6%, that has to be in writing. Please connect with us on social media. You can like us on Facebook, follow us on Twitter, and check out our YouTube channel. We also have tons of free resources available on our website. And all of our publications can also be sent to you completely free of charge. And here are some resources on our website that are specific to today's presentation. You can find all kinds of helpful resources to help you be a savvier shopper under the Consumer Resources menu of our website.